TD Cowen has been surveying Chinese consumers, and it talked to more than 2,000 of them in key cities. And it says that Apple, Nike, Lululemon, LVMH, Adidas, and Starbucks and others do face rising risk in China because of the trade war. We're joined now by the authors of one of the authors of the report, John Kernan, Managing Director of Retail and Consumer Brands at TD Cowen. Thanks very much indeed for joining us. Just tell us very quickly about this survey, though. You talked to urban consumers in China.
Yeah, we surveyed 2,000 consumers on the ground in China across a cohort of ages and income levels across Tier 1, Tier 2, and Tier 3 cities. These were done in person by a Beijing-based advisory. Survey results were quite telling. I think the biggest conclusion from the survey was Western brands' favorability is declining and local brands are rising. This coincides with the increasing trade war and a very difficult macro environment in China.
That's it. You said Western brands, not just specifically U.S. brands?
Well, the U.S. has faced some pressure. We've seen some real weakness in luxury goods spending. It may not be directly related to their views about Western brands and more related to just the overall macro environment there. But the biggest loser in my coverage list in terms of brand preference in the survey was Nike, and they do hold a #1 position really in all their categories by a fairly comfortable amount. But who they're donating share to is very interesting. It's the local China-based competition. Companies like Li Ning, Anta, Fila were big gainers, and there were really very few Western and American brands that improved in their brand preference year over year.
That's interesting. Nike, I seem to remember, maybe out of date here, they have kept their pricing fairly high in China. They want to be seen as a premium brand, but obviously they might be forced to cut prices, I guess, if their franchises are in trouble.
Yeah, sure. They are managing certain franchises in China and globally down right now. There's 3 big franchises that they really let get over distributed over the prior years. That's the Jordan 1, the Air Force 1, the Air Max 95, and SB Dunks. Those franchises aside, there's the barriers to entry in China and really globally have declined. I think one of the other takeaways from our survey was the strength of the online platforms and marketplaces in China, the Taobaos, the PDDs, the JD.coms. These have tremendous scale with the consumer in China. And what they're doing is they're allowing newer entrants in the market to come and create greater competition. And that's both from a local brand standpoint, but also other American and Western brands like Lululemon, Hoka, On Running, Arc'teryx. So the competition is getting stronger across the board here, whether it's foreign or local for Nike.
That's interesting. What about Lululemon? Of course, it's dear to our hearts here in Canada.
Yes.
Do they face significant local rivals?
They have done an incredible job expanding their store base and brand in China. We were actually in China in October of last year visiting with the Lululemon management team. They've taken a very localized approach in China. They've taken a very premium approach in China, and they've done a great job connecting with the consumer in China on a grassroots level with some very effective marketing activations. So we're quite bullish on Lululemon's overall potential in China. Right now, it's about 15% of revenues. We think it can, over time, grow to about 20% of revenues. It's a very high margin region for them. And I think they're a share gainer in China for the next several years. The survey data certainly back that up.
Oh, that's interesting. Good news for Lulu. What about Starbucks? Of course, we've seen this massive swing in Asia towards coffee drinking after millennia of tea consumption. How are Starbucks doing in China, though?
Absolutely. Our restaurant analyst, Andrew Charles, had a lot of interesting points in this report on Starbucks. And I think the key takeaways were I think Starbucks' value perception declined a bit, and some of the local brands like Luckin Coffee and others rose. So it's a very competitive market over there in coffee for Starbucks.
And broadly speaking, then, I mean, even 20 years ago, Western brands were thrilled about China. They thought, well, 1 billion consumers, what can go wrong? And some have been big successes. But can you give us the big picture here? I mean, do they face a real challenge, a tougher slog now in the Chinese market?
Absolutely. The macro environment for the next several years is likely to remain very difficult. The China housing market continues to decline. We're only a few years into that cycle. We think it's going to last several other years. And within the survey we published, 42% of Chinese consumers expect housing prices to decline. It's a big deal because 60% of Chinese consumers' wealth is tied up in housing. So you've got a weak housing market, a fairly weak job market, consumer confidence at 30-year lows. I think the TAM that many of us thought was there in China, many companies thought was there in China, is probably smaller. It's going to be more competitive. There's more risk. And I think U.S. and Western investors in general are not willing to pay high multiples for China-based growth right now. And I think we're seeing that play itself out across the sector. Much of my sector, for various reasons, is trading near 5-year lows in terms of forward valuation metrics. And some of that certainly has to do with some of the risk in China. China can be a good market. It's a high margin business for many companies. I think it was the long-term growth rate and the durability of growth that some of us got wrong. I think the consensus and many of us got wrong. And now these companies are adjusting to that.
That's interesting that the local brands in some cases are, well, I guess upping their game, their intellectual property.
They're also making better products. They know how to connect with the Chinese consumer well. It's a more localized approach. The Chinese consumer, is being told to be more nationalistic by the government, and they're generally picking up on that and creating more competitive market. If you looked at the sector 5-6 years ago, this China-based competition was very subscale, and you really, relates to my coverage, you had the two giants in the space were Nike and Adidas. And they still are two of the bigger, Nike's the biggest and Adi's probably the third biggest, but they face much more competition and lower margins going forward than what they had previously generated.
John, thank you very much indeed.
Thank you.
John Kernan, Managing Director of Retail and Consumer Brands at TD Cowen.